We're thrilled to be hosting our pilot episode of the Building Blocks podcast. Our job is to keep you, the investment community, informed about the things that matter most. We'll discuss some of the macro trends we're paying attention to and dive into specifics in terms of our investment strategy, including how we are addressing market challenges and opportunities. We'll speak to some of the common questions we get from the investment community in terms of what you want to see and hear more of. So, without further ado, let's get on with the show. I'm Jeff Fredericks, and I'm joined by Steve Marino, Executive Vice President of Portfolio Management, and Craig Engling, Vice President of Portfolio Management. Welcome, gentlemen, to our pilot episode.
Thank you.
Good to be here.
Okay, Steve, let's start with you. We'll get an introduction if we could.
Sure. So, Stephen Marino, pleasure to be here today. I have the privilege of having carriage of driving our investment management function on behalf of our clients. And in our organization, that really instills the practices of investment research and strategy, portfolio construction and portfolio management, and finally the sustainability practice, and really bringing those practices together to drive performance on behalf of our clients.
Okay, Craig, same question to you. If you could tell us who you are and what you do.
My name is Craig England. I'm a husband and father of two great kids, 11 and 8. I started my career in the commercial real estate business in 2006, and after a couple stops along the way, joined Steve and the portfolio management team at GWLRA. I've been working alongside Steve and our team for the past decade. My sole focus and responsibility is for the strategy and management and performance of our two open-ended segregated funds. Essentially, I'm here to take all of the blame when things go wrong and none of the credit when they go well. But all kidding aside, listen, we've got a great team. We've worked really well together. It's a tight group. Kat, who's here with us today, and hopefully you'll meet in future episodes, is a big part of what we do, and excited to be here. Thanks for having us.
Great. Well, let's start by talking a little bit about the investment community. Why don't we start there in terms of the things that are top of mind for the investment community as you see it?
Sure. It's a great question. I think we certainly have, to your point, a lot of opportunity to dialogue with clients, prospective clients, and just industry participants. And I would say one of the issues of the day, which is getting a lot of attention, is valuations of real estate and whether the valuations that are on the books are fairly reflective of market conditions. And so certainly we spend a lot of time with our clients talking about the robustness of our valuation process, really trying to provide a deeper sense of visibility into the frequency of our valuations, the independence of our valuations, and the heavy benchmarking we do to help provide context around how our valuations may compare to our industry peers. And I think if we can do a good job of demonstrating the robustness of our valuation process, it really gives investors the confidence they need to remain invested. And I would say today, particularly so, with the robust valuation process we have, if we can provide that confidence, investors really are anxious to remain invested in our products and in our funds, and ultimately they get to participate, as I would describe it, in the recovery of real estate through some of these more challenging economic times that the industry has faced of late. I'd say the other headline of the day is simply just the underlying fundamentals that support we'll call them principal four asset classes in Canada. There's a lot of headlines that are leaking into Canada from the United States. Some of the underlying conditions are a little bit different. So again, just open, solid dialogue with clients about what are the true stories on the ground in terms of how each of the asset classes are positioned. What do the property fundamentals look like, and the ability to continue to generate recurring cash flow, which is ultimately why our investors are invested in this asset class. It is that ability to rely on the income that those asset classes generate. So the fact that 3 of the 4 asset classes are continuing to operate at vacancy rates well below 5% is really a very positive story. And in the same breath, there's that other asset class, office, which has a slightly different narrative attaching to it. And it's important that we bifurcate how the office market as a whole is doing, where the winners and where the maybe more challenge assets may be. But certainly, providing that visibility and that context to clients is an area of interest for them.
All right, gentlemen, let's turn our attention to current market conditions. The Bank of Canada, of course, has announced some rate cuts in the last number of months, and inflation, hopefully, now finally getting under control. What does that mean for the real estate industry? And Craig, why don't you kick us off with your thoughts on current conditions being perhaps favorable now?
Yeah, I think things are evolving real time. To your point, the Bank of Canada has now cut 3 times the overnight rate. Markets are betting that we're just at the beginning of an easing cycle that could last well into next year, the end of next year. Inflation's migrating towards target, so those conditions are all favorable. Assuming that we are able to avoid a broader economic recession, those conditions set up really well for real estate. The cost of capital is coming down. It's an important input into the investment equation for real estate investment. We think that ultimately there's a lag with respect to what's happening real time on the ground and what's going to happen with respect to transaction activity. Deals don't happen overnight in our business. It's not the same thing as pulling the trigger on buying a stock. From inception to execution, you could be looking at a 3 to 6 month window to get a deal done. So, there's some rumblings of increased activity coming. We do think there's going to be a lag before you actually see it in the data. So, our expectation would be that late this year and into early next that some of that activity picks up. And that ultimately should be positive for asset values and for performance for funds like ours.
Great, and Steve, maybe you can just add to that with respect to investor sentiment and whether or not these rate cuts are in fact what will lure investors that may have been on the sidelines back into the fold, or maybe even developers that were waiting for conditions to improve before they start to put shovels in the ground again.
Sure. I think Craig made a great set of comments about the capital market conditions that underpin the asset class, and I would say those are important conditions, but I would say those are generally more short-term oriented in terms of where that cost of capital is going and the implication it has for new investment decisions being made real time. I think as investors, our role and obligation is to look through these short-term conditions and cycles and truly try to understand the building blocks, pun intended, of how it is we create value over cycles. And that's really about buying enduring locations, building assets that are positioned to perform today and tomorrow, and really looking through those conditions to ultimately drive performance. And if I think about that combination of conditions, that does mean from time to time, the marketplace will stop delivering new buildings because the cost of capital is prohibitive. Again, we're trying to see through those conditions. How do we build this portfolio for the long term, both in terms of asset class composition, but individual asset performance characteristics that we think can drive performance. So, today, to Craig's point, I'm more confident about having now seen peak cost of capital, and a environment where the cost of capital is coming down should be constructive to performance, which means we should be hopefully moving towards generating positive capital returns, which will be a nice evolution of performance given some of the valuation changes we've seen over the last 24 months in particular across some asset classes. So that's constructive. But as importantly, we need those property fundamentals to continue to hold and really be the key drivers of income through the portfolio, which is, again, the key reason why investors come to this asset class. It's for that income generation that ultimately we can capitalize on over cycles to generate performance. So it's exciting for me because I think we've certainly gotten to a pivot point now on a few of the asset classes where the fundamentals certainly set up more favorably moving forward.
Part of your question was related to development, and it's a good reminder. Development is obviously part of the overall transaction activity equation, and it's been stalled. It's been muted alongside everything else. The cost of capital is a significant input into ultimately building a building and being able to use financing, construction financing in particular, to get projects off the ground to address the housing shortage that we've talked about as an example. But it's not limited to just the cost of capital. It is a significant and material input into that equation. But ultimately, we're struggling with elevated input costs across the board, coming off of the inflationary environment that we've just come from. Materials, labor, every single input that goes into that equation is up, and it's making development ultimately uneconomic. So as those conditions improve and continue to improve, we would expect to see both increased activity on investment transaction of income producing assets, but also hopefully developers starting to put those shovels back in the ground and delivering new supply.
The good news is that would suggest that all of the assets that are income producing and in place today are certainly going to benefit from that riding tide of those existing assets being somewhat constrained in terms of the threat of new supply today. And so arguably they should have more pricing power and should be better positioned to perform. And these new best-in-class assets being delivered with inflated inflation costs or inflated input costs and inflated financing costs are going to have an economic disadvantage in terms of the rent they need to position at. So there should be a compelling value proposition for owners of hard assets today to understand how do we position to drive performance despite maybe some of the less than shiny virtues or characteristics of some of these assets. So every asset has a position in the marketplace. It's about trying to find the right price point to deliver the appropriate rate of return for that asset.
And of course, you guys rely heavily on input from research that you can gain, both from a macro perspective, but also what tenants are telling us in terms of surveys on their needs. How important is that research in how you make your investment decisions moving forward?
It's critical. I think we're a very disciplined organization as it relates to our strategy. We have a dedicated research team that has 3 strong players on it that really help to drive the foundation of our strategy. And it's really focused top down in terms of macro trends and secular themes that are evolving that will impact the demand for different asset classes and different forms of asset class. And in the same breath, we're also very micro-focused in terms of how do those themes play out at the property levels to ensure that we're positioning individual assets for performance as well. So I really like to think about it from a top-down perspective as well as a bottom-up perspective on how do we leverage that research to really inform property positioning in each of the markets we operate in.
It's research from a more broad level or macro level, and it's also research that we can fish from our tenants directly through tenant surveys and making sure that we're talking to groups. Like, we find it incredibly important to have and to develop deep relationships with our tenants to understand their needs, talking about how space requirements evolve over time. We always want to be the option 1, 2, and 3 for our tenants, whether they're growing, whether they're shrinking, or whether they need to move to a different location. So, I think curating those relationships is important ultimately in creating confidence that we can to deliver for them. And we've had a long track record of being able to do that, and listening is a big part of it.
I think, Jeff, the other thing I would add, just as it relates to research, is trying to ensure that we're positioned with our clients to be able to provide them some context on secular trends that are emerging, what they may mean for the positioning of capital, and how do we drive performance across the portfolio, both with conditions that are present, but maybe as importantly, conditions that we think may be formulating when I think about population change and some of the elements that will mean to our real estate. It's about trying to understand what is the demography of our buildings, what are our future tenants looking for. I think about every time we build a new multifamily building, we're trying to understand what is the local demography going to look like, how does that position in terms of suite mix. So we really use that research, if you will, both to inform secular trends and macro trends around what asset classes do we want to invest capital in, but then as importantly, how do we actually execute that at the property level to ensure that building is best positioned for today and maybe more importantly for tomorrow as well, so we can really be future-proofed effectively.
Well, and that leads to another very important question. Of course, when we talk about the future, we have to imagine the continued impact climate change is having on our future, and how, if you're managing a portfolio of buildings, how do you ensure that those buildings adjust to future conditions? Maybe you guys can just riff a little bit on both from a macro perspective, the impact climate change is having on real estate decisions, both in terms of investing and adjusting, or rather modifying the existing portfolios that you have.
Sure, I'm happy to jump into that one. I think a few years back now, we instilled a fairly robust filtering process for climate change to really help us understand what acute risks do we face as owners of real estate when we go out and look at potentially buying pieces of real estate. We should understand what the floodplain risks are before we own them, rather than come to learn what they might be post or subsequent to our ownership. So taking a more proactive approach to understanding those climate risks, I would say, was a great first step. But as importantly, we're really working hard now to understand the real estate we do own. What can we do to fortify those assets and insulate them from climate risks? And which assets ultimately may we not have answers for? And maybe in those instances, the next best course of action is to ensure that we're insulating the portfolio from any of the risks that attach with those assets. So that may entail a sale of an asset that we don't feel comfortable about. There's also, importantly, a very significant change in the insurance landscape that attaches to these assets. And the cost of insuring assets that are in areas of exposure is becoming somewhat cost prohibitive. I think about Florida as an example in a more extreme case in the US. Fortunately, Canada, generally speaking, has a far better geographic orientation in terms of mitigating some of that exposure, but we do have coastal areas that have some exposure, and it's important that we understand that we have resilient assets that are well positioned to meet the test, as I would describe it.
Yeah, and Craig, anything to add just in terms of, maybe even what our tenants in these buildings are telling us? To your point, you do tenant surveys. To what degree are they now starting to ask more, poignant questions in terms of our plan on making their buildings more energy efficient?
Yeah, there's no one conversation that's happening. I would suggest each tenant is making their own decisions, not unlike the conversation we were just having around utilization of space. Really, for some it's very important. For others, it's not top of mind. Whereas ultimately, cost becomes the biggest factor in their decision making. We are certainly starting to see it more and more, and would expect that trend would continue. We've done a nice job over time certifying all of our buildings with LEED and BOMA Best standards to make sure that we're staying on top of best practices, and we're going to continue down that road. When we're making significant capital reinvestments into buildings, replacing systems and things like that, we've got a lens to what's the best thing that we can do ultimately for the portfolio from an ESG standpoint. But to Steve's point, in some cases, those conversations may result in an uneconomic outcome, and ultimately we may have to pivot and decide that asset is no longer relevant for the portfolio in terms of our ambitions on a go-forward basis. Earlier, I asked you about what's keeping the investment community up at night. Maybe you can tell us some of the things that if you were meeting with investors and tucking them in, that you would say to them with respect to easing their mind about those concerns. How about you, Steve? The things that you think the investor community needs to sort of be reminded of or hear to calm any of their concerns.
Listen, I think I would start the conversation around valuation foundations in terms of how it is we arrive at values and the comfort that should provide in terms of those values being a fair reflection of market value and not a lagging or dated reflection of asset class valuations from 3 to 5 years ago. So ensuring that values are current, I think, is a key staple of what a real estate fund like ours needs to be able to do. As importantly, though, I think we need to continue to remind investors that this is a long-term strategy that we are affecting. These are hard assets. They are not in a public market that can find liquidity overnight. These are hard assets that have strategies that attach. In some cases, those strategies take 3 to 7 years to work through to execution and completion. And so that's a full economic cycle, effectively. And investors should really be making or be reminded of that understanding that we're making long-term decisions in our assets, and it's about driving reoccurring cash flow. And I think a solid and deep understanding of that really allows investors to stay invested through cycles to gain the benefits of compounding that they would otherwise lose in terms of trying to time the market. And I think providing that confidence is certainly critical to keeping investors well positioned.
So Craig, anything to add to what Steve said in terms of strength of the real estate market and where we're headed?
Yeah, I think I would just add that the value of diversification is real, and it's never been more apparent than it has been over the last couple of years coming off of the heels of the pandemic. We're sitting in a place today where fundamentally the other three asset classes outside of office are very strong. Within our portfolio, we're sub 5% vacant across the other three asset classes, which is important. So, that diversification has been able to weather the storm, if I could call it that, with what's going on in the office market. And that long-term thesis that Steve just described is important in understanding that different asset classes within the broader real estate sector are going to perform differently at times. We've just come through an extraordinary period of performance in the industrial market, as an example. If you wound the clock back 10, 15 years, industrial was one of the sleepiest asset classes that we would have had, and certainly wouldn't have been something that would have been high in the mind of investors. So being aware of those cycles and really having a large portfolio that has the value of that diversification in place is something that helps with us to be able to deliver on our long-term goals, which is producing income consistently for all stakeholders across the board.
It's a great point, because I think about when we do some deconstruction of performance over the long term, and we've done a lot of this work using some of the market benchmarks that are available. Over the last 20 years, every asset class has been the leader in terms of absolute performance over 3 to 5 year horizons. And so it's really a product of owning the right asset classes at the right cost basis to really continue to drive performance. And if we're doing our job as managers, it's about selecting the right assets on a go-forward basis. And I think those opportunities present in each of the 4 major asset classes we invest. We often get the question, what's your favorite asset class moving forward? And I would say, I like all the asset classes moving forward, assuming we can buy them on the right basis going forward. And so it's really about identifying the right assets at the right price point and the right strategy that we're all aligned on in terms of being able to drive performance.
Yeah, so a key part of this whole thing is staying on top of trends, staying on top of what tenants are asking for, but also keeping your eye on ways in which we can, maybe it's leveraging technology or whatever the case may be, improve the assets overall and make adjustments as needed. This has been a great conversation, guys. Thanks very much for taking the time to share your thoughts. We'll have more of these conversations moving forward, but I want to thank you again for joining us today.
Thanks, Jeff.
Great.
All right, well, that's it for our first pilot episode. We hope you enjoyed it. Please let us know what you think by visiting us at GWLRA.com and clicking on Invest with Us.